Ticker symbol NTAP is up around 36% in the past year. This has recently been a troubled growth machine with only 8% year-over-year revenue growth, but it has faced consecutive quarters with net margin expansion. Could this be a low-growth company ready to take off? So today we'll be looking at NetApp, a cloud management data company. In their annual report, they state that they help customers make their data infrastructure more seamless, more dynamic, and higher performing. So basically, they help modernize the different infrastructure of companies, prepare against cyber attacks, and even build scalable databases across physical and digital environments. What I have understood that they basically do is that they power all the data that companies are storing in the different clouds of, for example, Amazon Web Services, Microsoft Azure, and even Google Cloud, making this data a lot more manageable and a lot easier to extract actionable insights from. So I think this is a very, very good idea because you're building on something that is clearly working, like are these cloud providers, and you're actually increasing the value that these offer by just adding your, for example, add-in or your different services that you provide to companies already hosting their data on these platforms. Now, this company is extremely innovative and they currently have over 2,000 active patents and are investing heavily in new product development activities every single quarter. They believe that this is how they actually got to the point that where they are in, and they want to keep their leadership and expand their growth by actually investing a lot more into research and development. Now, one thing to keep in mind from this company is that the sales to two of their major clients, which are Arrow Electronics and TD SYNNEX Corporation, each accounted for 22% of net revenues in the fiscal year 2024. So if both these clients actually decide to end their partnership with NetApp, they would lose around half of their total revenues. And this is a very big risk to keep in mind. Now, jumping onto their financial analysis, this company has a very high return on capital employed of 30%, an amazing interest coverage ratio of 19 times, and a very solid cash conversion of 87%, with their profit margin sitting at 71% and their operating margin sitting at 18% above our threshold for this figure. Now, when we look at their financials here, we can see what we were speaking about. Now, this company had a period where they were growing at a very fast pace, but since July 2022 and a bit even before that, their revenues have pretty much been stagnant. Their gross margin and their net margin have been consistent, but their net margin has been growing quarter over quarter for the past year, which is something positive. Hence, we can also see that their efficiency ratios have been increasing consistently for the past quarters, especially their return on invested capital, which is currently sitting at around 50%. And when we look at their leverage analysis, we can actually see that yes, their total assets are above their total liabilities and have been for a while. However, it does not seem like they're making any effort to actually reducing their liabilities. So now when we move on to their fundamental analysis, this company gets a solid 6 out of 8 ticks, as first of all, they have a very low liability risk with an interest coverage ratio of 19 times. They have a very solid balance sheet. Despite having a lot of liabilities, they can actually pay all of their short-term liabilities with their current assets. Now, they do offer and generate consistent free cash flows. However, they haven't actually been able to grow these organically. The main reason why being that they haven't been able to grow their revenues organically either. This company does pay dividends and they also conduct share buyback programs, allowing them to redistribute all their free cash flow back to the investors. And now when it comes to the most important factors of this slide, which are the pricing power and the competitive advantage, it looks like NetApp actually meets them both. Starting with the pricing power, to me this is defined as the ability of increasing prices above inflation without actually losing too many clients. And to me, NetApp actually has this. Due to its seamless integration into the different cloud providers such as AWS, Azure, and Google Cloud, they're actually able to provide subscription services to different companies which will actually get a lot of value from these services. These companies pay a lot more money for the Google Cloud services than for NetApp's offering. And this, of course, makes them a very small portion of their overall costs, which allows them to have a lot of room to run before companies actually start squinting at the price of the service. Additionally, one great thing about them is that they have a recurring revenue model. A lot of their services are actually offered as subscription, and when you're offering a company a subscription, especially for data management, when you're making it so easy for them to actually manage their data, it would be very hard for them to actually change based only on price. This not only creates competitive advantage, but it actually gives them pricing power as they're able to increase the prices knowing that it will be tough for clients to actually switch providers. When it comes to this, we can also see that they have a big chunk of competitive advantage coming from their more than 2,000 patents that they currently have active. This allows them to provide a service that no other competitor can at the current moment and become the sole providers of those certain offerings or those certain functions that they offer to clients. Additionally, not everyone can enter into partnerships with these 3 cloud providers at the same time. So by NetApp doing that, it has secured itself a spot as the leading data management provider, especially when hosting data in these clouds. When we look at their dividend, they actually pay a very juicy 1.56 dividend yield with a very solid 36% payout ratio. However, as we can see, their dividends, although growing consistently, they're not growing by too much. But when we look at their valuation analysis, this company is trading at close to the highest it has been trading in the past 4 years, currently trading at around 24 PE ratio. And when we look at their free cash flow yield of 5.17%, this is way above their 3% long-term inflation rate, which actually suggests that this company may actually be undervalued. However, when we look at the risk and possible challenges, the main one that I see is the worsening competitive landscape, as now with the development of new technologies, especially the in-house developments that Google, Microsoft, and Amazon are developing, this could actually limit the exposure and the client reach that NetApp is currently having. Because one thing that I do see happening in the mid to long term is that these 3 companies will each create a way of actually making the data more manageable in their cloud offerings and actually improving the analytics side of their business. And what I think that this would do is just kick NetApp out of their services, which creates a very big risk for this company. But now the other risk that I do see is them not meeting performance objectives, and this is mainly due to the fact that I don't see a lot of guidance and I don't see a clear path to actually returning to high growth for this company. So we should keep an eye out for this. And now before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I do believe that this company has a strong competitive advantage. They provide consistent and predictable cash flows, and they have a high return on capital employed. So although I believe that this is a good company and may be a good investment, I think that their low revenue and low net income growth, paired especially with their competitive risk, does not make this an appealing investment. Now, having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.